Market Movers, where we identify market-moving headlines and then discuss ways to either hedge risk or create exposure to affected assets. We have Scott and Martin.
Hi, Jim.
So, Scott, we have two big headlines this week. One is states opening up or talking about opening up, and we have more and more government stimulus. What's the bigger deal, and what assets are going to be affected the most?
To me, it's the stimulus, Jim. I mean, it's great news, I guess, or great hopeful news that some of these states will be reopening and the fact that maybe they will have on the economy, which would be positive. But I still believe it's a stimulus-driven market. I mean, look at all the money we're printing out of D.C. and therefore out of the Treasury Department. And therefore, those are real numbers, Jim, that the market sees going into the economy, going into the hands of consumers and businesses. So as stimulus keeps flowing, I think you're looking at areas like the NASDAQ, which has been a very beta trade, both up and down, and GC. So NASDAQ NQs and GC in the gold contract. As more money's printed, more liquidity is out there, gold reacts.
10-year yields seem like they're trying to push low beyond, like, let's call it 0.6%, which is an all-time low. Is that because of the stimulus as well?
It is, but it's also inflation-related, Jim, too. I believe that the concerns about, say, disinflation or, dare I say, possible deflation are affecting yields very much and therefore affecting ZN and yields as well.
Okay, so CME has a 10-year contract, extremely liquid. Also options, weekly options, quarterly options on that. They're very, very deep. On to gold now, because gold's been trending higher with the dollar as well. The dollar trending higher is odd to me, considering all the stimulus and all the dovish policies coming in. Can this continue?
Yeah, it can. And both can go up together. I mean, as we've seen in times of panic or crisis or certain volatilities, there's reasons that I guess traders buy both assets. But in my opinion, GC is the contract that you're going to see a lot of, say, oomph into as we continue to print money, continue to inject liquidity, as the Fed continues to speak about a dovish stance. That's where I believe a lot of that energy is going to go into in the GC contract.
Okay, CME has the GC contract. They also have a micro gold MGC, and they have options on gold as well. Last topic, Tech Week coming up. Has it lost some of its luster in the shadow of these other headlines?
It's lost just about all of it, Jim, because a lot of these tech companies, while they're fun to watch, they've had a lot of beta in them. We've seen a lot of beta in the NQs. The reality is there's no visibility out there. So in my opinion, unless the data is really, really good and the outlook is really, really good, which is very unlikely, it's still a stimulus-driven market and not an earnings-driven one.
Minor disagreement there, I think, is I have some of these FANG stocks, and I tend to use either the NQ, the micros, or the options to hedge them going into these binary events like earnings week. Thank you for joining us on Market Movers, where we are helping to make you a better trader.